Hi, it's the analyst from Think Like an Analyst, and today we're going to take a look at a handful of semiconductor stocks that are expected to benefit from what some are calling a semiconductor supercycle. The catalyst for this supercycle is the confluence of a number of secular trends, including AI, 5G, blockchain, and a general increase in demand for consumer electronics. And this in turn is driving increased demand for semiconductor chips and equipment. The focus of our analysis will be on whether or not the prospect of a semiconductor supercycle has been priced into these stocks. To do this, we're going to go back to the basics and focus on the fundamentals. And the best way to do this is to build a simple model for each company. Let me show you what I mean. As I said, the models we are using are simple and narrowly focused on what McKinsey calls the key drivers of value. That is revenue growth and return on invested capital. Everything else is just a detail. Now, having said that, we've further decomposed our return on invested capital into its constituent drivers, which are NOPAT margins and capital turns, as this allows us to generate a CapEx forecast, which we need to produce a cash flow forecast. For anyone who's interested in digging deeper into the topic of valuation, I would highly recommend you check out McKinsey's classic book called Valuation: Measuring and Managing the Value of Companies. It's been my Bible for the last 25 years. Now, to produce our forecasts, we've again tried to keep things simple and have used past performance, consensus estimates, and comps as a guide. This is what I would call the quick and dirty approach to modeling, as it allows us to do a proper analysis without having to dig too deeply into the details of each company. So let's use AMD as an example. AMD's revenues grew by 45% last year and are up by 74% over the last 12 months. For fiscal 2021, analyst consensus has revenues growing by an astonishing 51%, and then by a further 15.6% in 2022. And we've simply plugged these numbers into our model as a starting point. Beyond 2022, we've tapered our revenue growth forecast down to 15% per year through 2030, which is roughly in line with our industry forecasts for that period. In terms of NOPAT margins, we fixed our estimate at 15% over the entire forecast period, which is low compared to its peers, but still at the high end of historical trends for AMD. And finally, we've fixed our capital turns forecast at 3.25 times, which again is at the high end of trend. Altogether, this combination of forecasts produces a return on capital of almost 50%, which again is at the high end of trend and feels slightly aggressive. But despite what we would consider to be an aggressive set of forecasts, our model produces a fair value target of $83, which is well below the current market price and well below the consensus price target. And a quick check against some valuation comps confirms that on a relative basis, AMD does indeed look slightly expensive. When we take a closer look at Qualcomm, on the other hand, we get a different picture. We've used the same structured approach to developing our forecasts as we did with AMD. That is, we've used consensus revenue forecasts for the next 2 years as our starting point, and then stabilized revenue growth at a more conservative 10% per year for the rest of the forecast period. On the other hand, Qualcomm's NOPAT margins are wider than AMD's, mainly because of higher gross margins. So we've fixed our NOPAT margin forecast at 25% per year, compared to our AMD forecast of 15%, which is consistent with past performance. And finally, we've stabilized our capital turns forecast at 2 times, which again is in line with past performance. This combination of NOPAT margins and capital turns produces a return on invested capital forecast of 50%, which is very comparable to. to our return on invested capital forecast for AMD. Despite the fact that our growth forecasts for Qualcomm are more modest than they are for AMD, our model produces a fair value target of $221, which is well above the current share price, and also well above the consensus price target. As a reasonability check, we can refer back to our valuation comp table, which confirms to us what our model is telling us, which is that Qualcomm looks cheaper than its peers, except on a price-to-book value basis. We've taken the same consistent approach to our analysis of all 5 semiconductor companies, using a simple model as our analytical tool of choice. This has allowed us to translate the semiconductor supercycle story into a set of explicit financial forecasts, which we then use to value each company. What we find is that the sector as a whole looks slightly undervalued, except in the case of AMD, which looks slightly overvalued. TSMC, on the other hand, looks fairly priced at current levels. We should emphasize again that this has been a quick and dirty analysis, using a simple model as our analytical tool. Nevertheless, our approach is structured, disciplined, and consistent, and the model allows us to put some actual numbers to the semiconductor supercycle story. We've made our models available below and invite you to download them so that you can play around with the numbers yourself. Happy modeling.